Over the last 20 years, 92% of actively managed funds have underperformed the S&P 500 index. This single statistic should shape how most people invest. Index funds are mutual funds that track a market index. They offer automatic diversification, low fees, and historically strong returns. The downside is they only trade once per day, a market close. ETFs work like index funds, but trade like stocks throughout the day. They tend to be more tax efficient and often have slightly lower expense ratios. For most investors, ETFs are the optimal choice. Stock picking can outperform, but only if you have the time, knowledge, and emotional discipline. A core satellite approach works well. 80% in index ETFs, 20% in individual conviction picks. Side-by-side comparison chart showing 10-year returns, expense ratios, and tax implications of VTI, VFIX, and a sample stock portfolio. Tell me in the comments which investment type you prefer and why. Subscribe for weekly investing insights.